Hey, good morning, everybody. Kevin here with Dwayne. How you doing, Dwayne?
Hey, good, bud.
Good,
Be
excellent.
back. Yeah.
Oh man, busy couple of weeks. I gotta say, the fourth quarter in the note industry, everybody, is an interesting time because you have funds that are companies that buy in bulk. Sometimes they do workouts and then resell. Sometimes they just buy for a nickel, so to speak, sell for a dime, that sort of stuff. And they go through cycles in which they have to close out these funds. And you never know which, well, you kind of have an idea which funds are gonna end up doing that. But that's the time of year when they do it, fourth quarter. So they start to get to a point where they have to liquidate these assets, not necessarily because they want to, but because they need to. They've got to pay the investors back. We've seen that cycle over and over again. And what you have to distinguish, though, is between which are the sweet deals that fall in that category of, boy, we'd rather keep this, but we have to sell it, versus some of the stuff where they're just going, man, we just gotta we gotta get this stuff on our off of our books because it's killing us. And that's where some new investors make a big mistake. They see a rush of assets, and then they buy what's the term I'm looking for, Dwayne?
Closeout sale. Hey, guys, end of the year,
Yeah, the tails. Yeah, the
the
tails.
tails
The
of it.
stuff
Yeah.
that everybody's seen and nobody wants, and everybody else has passed on, and now you get a shot at it, kind of stuff. So
Yeah.
it's an interesting time of year, and again, you've got great opportunities, but you also can have a little bit of an elevated risk if you don't know what the heck you're doing.
Yeah, sure.
Because there are some things that are hitting the market that they just have been dying to get off their books. And again, when people see a flood of inventory, they have a tendency to look for something. And so don't fall into that trap, everybody. Don't, make sure that you're doing your due diligence. The other thing is we're seeing more land notes, no question.
I
And
think that I think the well, I know on my end, the people that I talk to, it's more of a younger, sophisticated group of investors that are coming through the door. I mean, that people that I talk to are um I wouldn't say I wouldn't say very young, but I think they're realizing that they have to depend more on personal security versus social security of what's going on in today's world. And they're really realizing that, hey, this is the route, this is the direction I want to go. And they see the importance in investing in notes and, trying to create some generational wealth.
yeah, I think in a broad sense, alternative investments as a category is becoming more attractive to the age group. Um,
Yeah.
and then within that, what are your choices? And
Hmm.
a lot of them take time, and that generation you're talking about, that's one thing that they don't have, and is a lot of time. So to go out and try to say, well, I'm going to start a real estate flipping business. Got news for you. Dwayne's done a lot of flips. I've done well over 100, or so. It's a lot of work. It's a lot of effort. It's a full time
That's a
job or something
job.
like that. If
It's
you're
a
looking at
job.
that as an alternative. Yeah.
It's a job. I mean, it's literally a job.
Yeah. Yeah. And I think, the crypto and those sorts of things, although there's a market for it, boy, it just, it's one thing to jump into something you absolutely know nothing about. Um, and you can get burned. And that's why we do what we do. And that's why Dwayne works with so many people that are introduced to this, and advises them on the best, type of education that they can get. But if you want something that's a little easier to jump into, that's where I think Notes has that attraction, and it can be something small to get your feet wet. And I had a lot of that going on over the last couple of weeks, and I've got two case studies I just put together yesterday that I think will illustrate that, and also the concept of investing in notes that are backed just by vacant land. The risk that you have with vacant land is really understanding what the valuation of it is and what its highest and best use is. And that's something that falls sometimes on deaf ears. I've seen people buy notes on land that's just way out in the middle of Texas somewhere. It's like, what are you going to do with it if they don't pay?
Yeah,
Well, they keep paying, and then all of a sudden they don't, and now you're stuck with a piece of land that takes you 4 hours to drive to from a big city, and your land's being used by somebody else, and that there's nothing you can do about it, and they
yeah.
run into those little pitfalls there. And it's also land like that where somebody scoops it up through some kind of foreclosure, through some sort of tax deed sale, and they might pick it up for $5,000, and then they remarket it for $25,000 to somebody, but they sell it on terms, and they're just grossly exaggerating what the property's actually worth. And when somebody who doesn't know what they're doing looks at that piece of land, there's no comparable sales. There's no other land that's been selling that way. And they go, well, it's only a couple $100 a month the person's paying. And then they find out, sometimes those small deals, you get stuck with them. And then what are you going to do? Now, all of a sudden your foreclosure cost gets in there, and your returns just get absolutely crushed on that. And then you take back a piece of land that the only way you can sell it is to mark it up and sell it on terms to somebody else too, and just hope, the next party comes along.
Yeah,
But
for sure.
let me show you some of these, Dwayne, that we've got done this week here.
That
Let's see.
portfolio, is that what you have?
No, no. I'm going to do some small notes. I'll do the portfolio because we're still working on that. But this was a small land only note, and it was a good starter note. This couple have been real estate investors for a long time. They've got rental properties. They have some multifamily, and like a lot of landlords, they get burnt out on that and just say, "Boy, we'd really like to convert over to notes." I mean, how many times have you heard that?
Oh my goodness.
Going, right?
Yeah.
I mean, it's a constant thing. Nothing wrong with being a landlord, everybody, but at some point, most people will reach that point of just going, man, this is just too much. Is there another way? And that's why, again, the real estate without renters is the way that you do that. So with this one, we started exploring, we started looking around, and here's all the details of this particular property here. It's in South Carolina, a little town I've never heard of in South Carolina. But I think I've got a picture here of it, the land, and I'll come back to the numbers in just a minute. But there's the land. It's a small lot, and there's a house on the left that you can see. There's a little bit of woods here on the right, but you can just barely see the second house on the other side. There's houses in back. There's two schools. There's a house back into the left. There's a house in front of this property as well. That's land that you would have no problem taking back, right? That has a higher and better use. That's an easy take back because you have the option of selling it to the neighbor, selling it to a developer, building a house on it yourself and selling the house. I mean, there's just so many different things that you can do with this, and it's in an area where people want to be. It's around schools, it's around other homes. You're not out in the middle of nowhere. So nice little find that we had here. And the numbers look great on it. Now, again, I said it was just a small note. A lot of people, are afraid of jumping into something. Well, I got to invest a whole bunch of money. And look, they were asking $13,500 for this note. Now, the backstory, I know all about this note, by the way, because I went and did all the research on this note with my clients here, and it was very simple. We got on in public records, and we found out that the property was purchased at, that should say tax, not tab. Let me fix that while I'm looking at it. The investor who bought this land, okay, bought this land from a tax deed sale, and they got it really inexpensively. They resold it on terms to another investor. And I looked up the other investor because it was an LLC. And an LLC told me that's not your typical just one person buying a note. It's not in their name, it's in an LLC. So I looked up that party, the person who bought the land and is making the payments on this property, and they own a bunch of rental properties in the area, everything else. So the thought process there, of course, is, well, what do you think that party's going to do? What do you think that LLC is going to do? They're probably going to build a house and resell it. Why? Because they own other houses, they own other rentals in the area, they've purchased other land before in the area. So just kind of connecting the dots of what do you think the most likely outcome would be is that you're not just having somebody buy it who eventually says they're going to build a house and they never get around to it. This is an investor who wants to convert this. He got a good deal on it to to a higher and better use, as we say in the appraisal lingo. So number wise, the property comes in around $35,600. Now that's something else that we verify, right? So we we looked at the tax assessor's office, which by the way has nothing in most all areas has nothing to do with fair market value. Taxable value is a completely different thing, but it is an indicator. When you see taxable value of 30 something $1,000, you know that the land's worth more than that. So we started looking around at some other comps and felt pretty darn good about the value that it's there. The loan is pretty new. They created it in May of 2024 for $15,900. And there's an unpaid balance of 14.6. So you're getting it at a discount. Your discount's pretty good. You're getting it at a good return. And the probability here is that they're going to be continuing to make payments because they see this as an investment for some bigger things that are coming down the road in this area. So number wise on this one, they're purchasing it with their IRA. So it just so happened that because they have rental properties and everything else, they've had some money tied up in other areas, but they did have a small IRA. And for a lot of people, if you've got a small IRA and it's sitting in a cash account, and Dwayne, you can remind me of what those numbers are if you remember how much money is sitting in IRAs sitting in cash, making nothing. There's an alternative. What's that?
It's a lot.
I can't remember.
It's a
I used
lot.
to.
I don't remember what it is.
Yeah.
But it's a lot.
Yeah, I mean it's crazy industry wide how much that is. So think about that. If you've got a small IRA or you have a kid's IRA that's got a little bit of money in it, 13 grand, the property's worth $36,000. Okay, so is your $13,000 investment safe? Okay, because that's the first thing we look at when we're talking with new investors, and whether it's Dwayne or myself, we're one of the first things we ask them is, what's your risk tolerance? Right? And depending upon the age, you brought that up earlier, Dwayne, you've got some people who are older and they're on that more wealth preservation
Absolutely
setting versus somebody who's a little younger and wants to get a little bit more, excuse me, aggressive, perhaps. But I would think anybody, I mean, if you look at that and go, your $13,000 investment is backed by something worth 3 times what you have in it. Are you safe? In other words, if you had to take that property back, are you good? Are you going to be able to make money? Of course. Okay, you got something worth 3 times what you what you have in it. So safety number one, we can check that box. And then we look at the return. So there's your financial calculator, everybody. And for those who are just listening to this by audio, if you run this through a financial calculator where you invest $13,000, in other words, that's your present value, and you're going to receive back 85 payments of $240.73 per month, that will calculate out to an interest per year of 13.78%. And again, I really challenge you to tell me of another alternative investment that gives you that safety combined with that kind of return. And I think you're going to be absolutely hard pressed to find anything like that. So is that a strong return? That's a very strong return, especially for a small investment like that. So you don't need a whole lot of money to get started in this. For these folks, that was a very small investment, but they're in the process of cashing out some of the rentals, and they were chomping at the bit, ready to go. And we started looking, they're going, hey, you know what? We got this small IRA, let's put it to work. And so we did a great job on that. That's a good buy for them. This is another one. And this is a land note. Most of you won't know who PMC is. It's Private Money Club. and I do a lot of work with them and their members as well. So the private money club are lenders, and lenders and buying notes are really pretty much the same thing. They're at least cousins, I guess you would say, or you know what I'm trying to say. They're related because originating a note and then buying a note that somebody else already originated is what we're talking here. So there's not a whole bunch of difference between the two. However, if you're doing a new loan for somebody who is unproven on a property that needs work or something like that, you are taking on more risk. See, we get the luxury of note investors to come back after the fact and go, you created it, you took on that risk, let's see how it went. And look at the track record, and then we can evaluate it. Hopefully by that point, the property value has gone up, payments have been made, they're establishing equity, we get to see a track record, and we can come in and buy that. But in this business, you want to create relationships with lenders, because lenders can be one of those sources that just continues to fuel you. And Dwayne, you've talked with people who one or two different lenders that they have a relationship with, that's all they need. That fuels all their notes.
Yeah, absolutely. So they have created that relationship and been able to, when they haven't been able to find inventory and or get cash, with that relationship, it has helped them out, several times.
Mm-hmm. Mm-hmm. So that's the relationship here. And I actually didn't know that when we first looked at this note. So when we first looked at this note, I communicated to the note seller, and they said, "Oh, Kevin, I know you. I'm one of the people on the private money club. I've seen you a couple times do presentations, and great. Thanks for taking a look at the note and that sort of thing." And so we started going from there. And when they put this initial listing up, there was some mistakes on how they filled it out and that sort of thing. So I went back and helped her with that, because again, I help people creating notes. I help people buy notes that have already been created, buy notes that are not performing, help people, the whole thing. So kind of pointed out some things that were inaccurate on there. She finally sent us all the documentation on everything, and the documents were perfect. It's just putting it into this system took her a little off track on some of the things. But what's interesting about this one is it is a brand new note. Now, like the other note on the land, and I don't have a bigger picture of this one for whatever reason in my slides, but it's a big corner lot and there's houses all around it. So once again, it's a very useful lot in this area, because chances are somebody's going to put a home of some sort on this property and live on the property. So great, that's what we're looking for. So $32,000 in property value here. Brand new note, meaning it's completely unseasoned. You can see it was originated in October 2nd, 2024. So they haven't even made their first payment yet. Now, normally that's taking on more risk than we want to do, right? Because the seller is very smart. They've already made their money because they bought the land cheap. I think this was a tax deed sale, if I remember correctly as well. And bought the land real cheap, sold it, got a good down payment, 20% down, and now they're cashing out of that note. So they're removing all of their risk out of doing this loan to the person, and we're taking it on so early into the transaction that we are taking on a little bit more risk. However, you have to weigh these things out, and Dwayne's heard me talk about this, I don't know, for 12 to 15 years about you're like the pendulum. You're adding out what's the benefit and what's the drawbacks on these notes. There's always good things and bad things. We have to look at those. So when you have no seasoning or very little seasoning, you look for, well, what was their down payment? How much skin in the game do they have? How much money are they putting up to risk? If these people had 0% down and their monthly payments are including taxes, $529 a month, but if that's all they're in it and they haven't made a first payment yet, that's a different ballgame. Here, they bought the property and they came to the table with 20% down. Now, we verified that, right? What's that?
Yeah, that's huge. I'd say that's huge. I mean, that's
Yeah,
a big downstroke.
Yeah, it counterbalances that fact of no payments, because now they've got money to lose. They absolutely have money to lose, which they don't want to do. she did a great job, the note seller, of using a short-term, high-interest rate loan. Because again, this loan is really more of a bridge loan to get them, boom, you got the property, you got it in on easy terms. You didn't have to go through the normal qualification process. You can refinance or build or do whatever later. If you're going to build a house, you can then do a whole new loan for the home building and develop the land cost in there, whatever they want to do. But it's a way for them to get in here. So they structured it at 12.9%, 72 monthly payments. And they also set up escrow, and also included, by the way, you might notice there's a servicing fee cost. So that was another smart way to build into this note, because normally there's a $15 to $30 servicing fee to have it professionally serviced. And once we got all of the paperwork and started going through it, and there's what I just said before, that, you know, PMC, and she knew me and saw me at some events and everything. And guess what she's already saying? Hey, I got some more coming. I got some more notes coming, of course, right? Of course. And
Absolutely. Yeah.
those look pretty good too. 149, 2 lots, they're putting $50,000 down, good down payments, that sort of thing. So this is one of those relationships that obviously you want to build. But we went through everything. There's a part of the note, there's part of the warranty deed with the vendor's lien. That's called the seller financing in Texas. And then she had a nice breakdown for us of all the numbers. Here's what they purchased it for. Here's what the down payment was. And by the way, we did get a copy, which I didn't put on here because it doesn't fit in the screen too well to see the details. We did verify that it's a true down payment. Okay, we did verify how much money they had to bring to the closing table. That's called a settlement statement, also known as a HUD-1 form. And we looked at all of that to make sure. And here's all the details on the note, how it all broke down for servicing, as well as taxes and insurance, and the principal and interest on everything to come down to that bottom line. So well-created note, well written up, no payment history, but again, countered by the fact that these folks have put 20% down, which eliminates your risk. But nonetheless, there's still some risk there. So that's why we buy these things at a discount. So if you recall, the unpaid balance on this is $22,000, but she's asking for an offer on this one. Okay, knowing that we're coming in at some more risk. So when it comes to risk, what we first look at is, well, what is the property really worth? You know, that's one of the, sorry, I'll go back to this one. What is that property really worth? Can we find decent comparable sales? Can we deduce somehow that the property is worth $32,000? Because we have to look at that property valuation and think, how much is the most I want to be in that, right? So I'm certainly not going to pay more than $22,000, you know, but is $22,000 a deep enough discount for me to be in, or something less than that? Okay, so we started running through the numbers. And by the way, that means this is not a yield-driven quote. If we bought this note, just to clarify for those who are not familiar, if you paid $22,000 for this note, your annualized return is going to be 12.9%. That's what the notes originated at. If you pay anything less than that, your return is going to go higher. So we already know our return is good. So that's why our mind, you know, is thinking, what's the risk though, if I have to take this thing back? So here we go, because remember, there is a cost of foreclosure, everybody. So that changes your numbers quite considerably. So we went through, the 20% down was good. So got it for 18.4. Okay, so less than the asking price, but obviously still good enough for this particular property buyer and then note creator, if you will. So property's worth $32,000, purchased it for 18.4. Again, we can check the box of safety. If you had to take this note back, you're completely safe. Yield on this one, we knew it was going to be high, 20%. So higher risk, we still have the safety involved here. We're taking on a higher risk because if we do have to initiate foreclosure, even though this is in Texas, it's still going to cost about $3,000 to go through that process in Texas. Now, it's relatively quick as foreclosure goes, but there's still a cost involved on that. So you want to make sure that you think in terms of, okay, I paid 18.4, maybe they make a couple of payments, then it goes bad, then I got to pay another 3. Am I still good? Okay, so we still looked at all of those numbers there. So again, nice strong yield on that one with the safety involved as well. But on good quality land, that definitely has a useful value, and that's what it's a strong way to look at these.
I want to go back to a point that you said earlier, and that was, the investors coming in to where you don't have to have a whole bunch of money. And if you look, we talk to people all the time. Well, I don't have a lot of money. I have in my IRA, or I have in my business account, I have about 80 to $100,000. Well, I mean, right there is proven point that you don't have to have a ton of money to start doing the business. If you went out and did a rehab property, could you go find a rehab property that you wanted to flip for 18 grand? And I'm going to tell you, in today's market, where I live here in North Carolina, you don't see it.
No.
And so and that, I mean, you've been in it well longer than I have. And just all across the country, we hear people out in Phoenix, we hear people down in Florida, we hear people in New York. I mean, they can't find inventory to where they can put their money to work versus, hey, I have 80, I have 100 grand, and can I go put it to work? It's proven fact. You just shown them right there that there is inventory out there. Even if you don't know what to do, at the end of the day, they have you in their corner, and just another set of eyes that we were talking with Bob yesterday. Having your professional set of eyes of looking at these deals, you may have an understanding, but how does this really work on our end? And so, there is hope for those that are looking to invest in not being a wholesaler or rehab.
Well, and to extend upon your point there, you can get loans, so if you want to buy a house to flip it, you can go $150,000 in debt and still have your, $15,000 on the side, maybe to put into rehab. But that's a whole different ballgame. You're in $150,000 in debt on a high interest rate loan. You've got cost of materials, cost of labor going up. And that's why we're seeing a lot of delinquencies on those loans. So be careful what you wish for there on some of those loans that you can get. Here, you're getting a higher return than you would probably get, interest rate wise, than on a flip right now, and you're not going into debt.
And I wasn't trying to say that you can't find deals. I'm talking about at this price point.
Oh, no, that's impossible. But I'm just saying there is an alternative where people go, well, I don't need to, I could borrow money, and buy something for 150. Yeah, those are around.
Yeah.
But do you want to be in that kind of debt right now? And what kind of return are you chasing, versus some of these alternatives here? So it's a great way to go. And this is something that we do. This is something that Dwayne and I have been doing for more than 15 years, and probably combined between the two of us, we've trained more people, got more people involved in this industry than anybody. And I think that's important to know too, because we know what we're doing. We know how to help people. We got people closing deals, every single day. So this opportunity it's growing. The industry is getting more recognized for sure. Going back to your point about younger people getting involved, we never saw that until more recently. And that means that awareness is there. So we're lucky that we're still in an industry, though, that we have a lot more opportunity than we can have people looking at those. In other words, there's more deals that are available. It's virtually impossible for the number of people who are in the industry to look at all the deals. There just is. So we're fortunate to be in that. So it's a great time to get involved in it. And I'm down to now, Dwayne, I'm also convinced, because I do so many of these one-on-one sessions with people, give me 2 hours, maybe 3 hours a week. That's it.
Yeah.
I've really got it refined down where I just, boom, I can zero in on what are you looking for? What do you want to accomplish? Is that real? Is that realistic? I'll set your, I'll put your expectations. I'm not, Dwayne and I are not some of these guys out there that, oh, you're going to make $1 million. You're going to make that. No. I want to set your expectations the right way. Here's what the industry can deliver. So does that something, and then we mold a plan on that. And then we start to look at assets together. And if you want to get started that quick, I'm telling you, I've got to refine down to that point.
You know, I had a conversation with Tom yesterday, you know, I'm talking about, and
Oh, yeah.
we spoke for about an hour, and he said, well, what are you and Kevin seeing? And I said, you know, people want to learn. And he said, you know, he was talking about going into creating funds and, you know, what do you recommend and how your training is and all. And I said, listen, I think because we have been in it for so long, most people out there that are doing training are working in such masses that they can't give the individual attention. And you and I have heard over the years, gosh, I wish I just had somebody help me have some eyes to help me and or hold my hand through the first couple deals. And I think that's where we stand apart from everybody else in the industry, because there are new people, again, younger getting involved, people that are older and they're realizing their Social Security at the end of the day is not going to help them, you know, for the rest of their life. What do? I have some capital. I need to invest it. And so he said, you know what, that really makes sense, because him being in Phoenix, he knows a lot of groups around that everybody works in the masses. Everybody's got to listen to the same thing over and over. And he said, my case studies and deals that I work on, they're, you know, it needs to be more honed in on just one-on-one time. And you do a great job with that. As your point, you know, 3 hours, you can set an expectation to someone for them to really get an understanding versus mass setting. It's hard to learn that way.
Right. Yeah. And you learn by direct application. There's no question about it. So that's what we're all about. So give us an email. Set a phone call. You know, you can set a phone call with Dwayne very simply.
Love to talk.
And we can talk about the industry, talk about what we can do to help you accomplish your goals in this. And we do it every single week, every single month. This is exactly what we do. And so our mission is pretty clear and direct, and we're not hard to get in touch with. So info@kevinshortell.com, and it'll be in the link as well. And we'll get you set up with a phone conversation and get you started. So it's something that if you want it to happen fairly quickly, it can. If you want to slow roll it, we can approach that too. So everything's done on your pace. But I'm telling you, it's the opportunities right now in this quarter especially are really strong.
And what I want to say, you know, a big thank you to you is you're a big advocate of not only teaching, but doing the business and growing the business overall, creating relationships with companies that have, you know, inventory that you create relationships with. And again, that separates us from a lot of the others that are out there where they may say they have inventory, but at the end of the day, they don't.
Right. Exactly right.
Or they're brokering deals. They may have it, but they don't. Yeah. They have no idea.
Or they're making big fees on you every time you buy something. It doesn't happen here.
Yeah, absolutely.
Good deal. All right. Thanks for tuning in, everybody. And we'll be talking to you again next Wednesday on the Watercooler Wednesday.